Okay, let's unpack this. We're diving deep today into something, well, a bit counterintuitive, but incredibly dangerous in global finance.
Yeah.
It's this global cascade, this chain reaction that starts with something seemingly simple. Central banks setting very, very low interest rates.
Right. And that kicks off what we call the yield chase. It's the systemic hunger, really. You see it everywhere. Big sovereign wealth funds, major banks, right down to individual retirees. Everyone's just trying to get a slightly better return than, basically zero from a bank deposit.
And that pressure, that chase.
It pushes capital, it pushes it into riskier and, frankly, often much more complicated corners of the market, places people don't fully understand.
Exactly. So our mission today is to follow that money trail. We want to explore how a crisis that really started in the U.S., the subprime mortgage mess, Lehman Brothers collapsing, how that didn't just stay contained. It jumped borders instantly.
Yeah.
It exposed just how brittle the whole global financial system had become. And it led to these catastrophic, often hidden risks popping up all across Asia. We're talking about severe impacts on everyday retail investors, particularly in Hong Kong and Singapore. And it also triggered this almost unprecedented economic policy shift within China itself.
Yeah, and the source material we're looking at, it really connects all those dots very clearly. You can draw a straight line, basically, from the U.S. subprime crisis kicking off in 2007, then Lehman going bankrupt in September 2008, straight to specific investment losses and major policy decisions being made in East Asia almost immediately after.
It's a fascinating, if worrying, case study in financial globalization, isn't it?
Absolutely. It shows how interconnected everything is now. Pain gets shared instantly. It doesn't matter if you're a giant investment bank in New York or, like the source material points out, a grandmother in Kowloon just trying to make her savings last. The shockwaves hit everyone.
Okay, so let's start right there at the epicenter, the catalyst. We're talking 2007, 2008. The U.S. subprime mortgage market starts to really unravel. And then the big one. September 15th, 2008, Lehman Brothers files for bankruptcy.
That wasn't just a tremor, it was. It was like a bomb going off in the middle of the global financial system. A detonation, really.
And you might think, well, China, with its capital controls, relatively closed system, maybe they'd be shielded.
That was the common assumption, especially maybe outside the region. But the sources we have confirm the exact opposite. China's big players, its major commercial banks, the state-owned giants, they were directly tangled up in this.
Oh, I mean, given those controls, what specifically were they holding that linked them so directly to, bad mortgages in Florida or California?
Well, primarily, they'd bought the same stuff that caused the trouble in the first place. Mortgage-backed securities, MBS, and collateralized debt obligations, CDOs.
Oh, the infamous alphabet soup of the financial crisis.
Exactly. These were the instruments that bundled together thousands of those risky subprime mortgages. They were packaged up, somehow got high ratings from the credit agencies, and then sold off globally. Chinese banks bought them. The 4 largest commercial banks in China, according to the sources, reported direct losses on these U.S.-issued securities, adding up to around $10 billion.
$10 billion. I mean, that's a huge number for anyone. But for China's massive banking system, it's huge foreign exchange reserves.
Yeah.
Was that really a systemic threat? Or more like, a very painful hit, but ultimately manageable?
You've hit on a key point. The direct losses, that $10 billion, while significant, were probably manageable for the system as a whole. Compared to some Western banks that went under, it was maybe even limited. But that was just the damage you could see, the tip of the iceberg. The real risk, the existential threat, was tied up somewhere else.
Okay.
It was tied to China's absolutely massive investments in U.S. government-sponsored entities. And this is where, as the source says, it gets really interesting. We're talking about the near miss with Fannie Mae and Freddie Mac.
Right, the giant U.S. mortgage entities.
Yeah.
Backed, implicitly at least, by the U.S. government. Everyone would assume they were rock solid.
Pretty much. And China had poured a huge chunk of its foreign exchange reserves built up over years from trade surpluses into buying the debt issued by Fannie and Freddie. Low risk, stable return, dollar assets. Seems safe. But the source material lays out the sheer scale of the danger. If Fannie and Freddie had actually collapsed, without the U.S. government stepping in, China stood to lose up to an incredible $400 billion.
$400 billion with a B.
$400 billion. Just imagine that hitting their reserves.
That's an amount that could destabilize a government.
Yeah.
So the U.S. government did step in, put them into conservatorship, prevented that absolute worst-case scenario for China's reserves. But the fear in Beijing, the realization that their main safety net, all those dollar assets, was vulnerable to a crisis in the U.S. housing market and ultimately to U.S. political decisions,
No.
that must have been profound.
Oh, absolutely. That near miss, you could argue, was psychologically far more damaging than the actual $10 billion loss. It just hammered home how deeply integrated China was with U.S. risk, even with capital controls. Because at the end of the day, the U.S. dollar is the world's reserve currency. There was no escaping that linkage.
And beyond the MBS, CDOs, and the Fannie Freddie scare, there was also direct exposure to Lehman itself.
Yes, a smaller piece, but still significant. Chinese commercial banks had bought about $1.47 billion worth of Lehman Brothers bonds. When Lehman went bankrupt, poof, that had to be written off completely, zero recovery.
Okay, so summing up this first part, direct losses on complex U.S. securities, a complete write-off on Lehman bonds, and this terrifying near catastrophe with Fannie and Freddie averted only by a U.S. government bailout. How did these external shocks, this experience, start to change China's thinking and strategy?
Well, what's really fascinating is how the shock itself became the policy driver. As we said, the direct losses were maybe containable, but the exposure revealed by the Fannie-Freddie situation was just vast. It basically confirmed Beijing's long-held suspicion. Relying on the U.S.-centric financial system for stability was just too risky. Unacceptable risk, really.
The $400 billion near miss showed their vulnerability wasn't theoretical.
Exactly. It forced them to think, we need our own firewall. If the global system can be this fragile, this dependent on U.S. housing, we have to build massive domestic buffers. We need to be able to stimulate our own economy internally, regardless of what happens outside. And that thinking leads directly to the huge stimulus package we'll talk about later. It was a direct response to that feeling of vulnerability.
Right. That covers the institutional reaction in China.
Yeah.
Now let's pivot. Let's go down to the street level, you could say. We need to talk about the ordinary retail investors, especially in major Asian financial hubs like Hong Kong and Singapore. They got absolutely hammered by something called the Lehman Minibond crisis.
Yeah, the mini-bond saga. And the name itself, mini-bond, is the first clue. It's deeply misleading.
Why? What does bond usually imply?
Well, usually a bond means you lend money, you get regular interest payments, and at the end you get your principal back, assuming the issuer doesn't default. Relatively straightforward, usually lower risk. These mini bonds, they were not bonds, not even close. They were incredibly complex, high-risk financial derivatives. Underneath the hood, they were based on credit default swaps, CDS.
CDS. Okay, those are the instruments that became infamous during the crisis. Essentially, insurance policies or bets on whether a company will default on its debt.
That's a good way to put it. And selling complex derivatives like CDS or products based heavily on them to ordinary non-professional investors. I mean, that's usually heavily restricted, sometimes outright prohibited in many places.
So how on earth did these things end up being sold over the counter, basically, to everyday people across Asia, retired folks, neighbors?
It was a perfect storm, really, driven by that same yield chase we talked about. Lehman Brothers, the creator of these products, wasn't a retail bank. They didn't have branches on every corner, so they needed a distribution channel. They partnered with major commercial banks across Asia, banks that people knew and trusted with their life savings.
The local bank branch.
Exactly. These local banks sold the Lehman Minibonds through their retail networks. And crucially, the banks earned very large commissions for selling them.
Which creates a powerful incentive, doesn't it, for the bank staff to push the product. The sources use the term mis-selling.
Precisely. The structure incentivized pushing these complex, high-risk products through channels that people associated with safety and security. And the research notes specifically mention who they were sold to: non-institutional clients. Often, yes, retired people, familiar neighbors, people just looking for something a little better than the tiny interest rates on their savings accounts in that low-rate world.
And what impression were these investors given? Did they understand the risk?
Overwhelmingly, no. The impression given, according to the sources, was that these mini-bonds were safe, that they were capital guaranteed, low risk, almost like a slightly higher yielding substitute for a fixed deposit.
A deposit replacement product, I think the source called it. That framing is just, wow, given what was actually inside. Can you try and break down that structure for us? Simply, why was it so risky and why did it blow up so badly?
Okay, let's try. Think about a regular savings account. Basically zero risk, tiny return. Now, the mini bond promised a better return. But where did that extra yield come from? It came from taking on layers of hidden risk. The money you invested didn't just buy a simple IOU from Lehman. It funded this complex derivative structure. And there were two main ways you could lose everything.
Two ways.
Yes. First, the mini bonds performance was linked to the creditworthiness of a basket of other companies called reference entities. These were often big, well-known corporations or banks. If just one of those reference entities defaulted on its own debt, the mini bond would immediately stop paying interest. Kaput. You're stuck holding a worthless note.
Okay, that's one layer of risk. What was the second?
The second layer involved the principal itself. The money the investor put in wasn't held safely. It was used to buy other complex securities, specifically synthetic collateralized debt obligation notes, CDO notes, which acted as collateral. Now, if that underlying CDO defaulted, which is exactly what started happening as the U.S. subprime crisis rippled outwards, then the investor wouldn't get any of their principal back when the mini bond matured. Nothing. Zero.
Wait, let me get this straight. They built a product that fails if company X defaults, or if this separate complex CDO sync defaults. And they sold this through bank tellers as a safe alternative to a deposit. That doesn't just sound complex. It sounds almost engineered for failure from the investor's perspective, maximizing their risk exposure.
You could certainly argue it was structured to transfer risk very effectively, away from the sponsor, Lehman, and onto the shoulders of the retail investor, all disguised by that slightly higher yield that looked so attractive. And the ultimate kicker, because Lehman Brothers was the sponsor, the issuer, the main counterparty, when Lehman itself filed for bankruptcy on September 15, 2008.
The counterparty risk materialized instantly.
Instantly. The whole structure collapsed. The value of these mini bonds just plummeted overnight, went to basically zero.
The scale of this in Hong Kong you mentioned was particularly huge.
It was devastating. Hong Kong saw the largest volume. We're talking a total of $20 billion worth of these Lehman-linked structured products sold through retail banks. And that affected over 48,000 separate investment accounts. Think about that, 48,000 families, individuals, many elderly, who thought their savings were safe, maybe even guaranteed.
The shock must have been unbelievable.
Palpable. Disbelief, anger, a huge sense of betrayal. And who did they blame? Not Lehman Brothers, necessarily. Many didn't even realize Lehman was the ultimate guarantor. They blamed the banks, their local bank branch, the people who sold it to them. The focus was immediately on what they called unreasonable sales tactics.
So the fallout was immediate. Protests.
Oh, yes. Large-scale protests, demonstrations in Hong Kong demanding action. It became a huge political issue. The Legislative Council there even passed a motion condemning the government for inadequate supervision. The pressure, politically and socially, became so intense that eventually the government and the banks had to hammer out agreements to compensate the investors. Basically a massive cleanup operation for the mess created by this yield chase gone wrong.
Right. So the mini bond crisis, it's almost the poster child for disclosure failure, isn't it? And our source material really digs into why it failed so badly. It argues that just ticking the boxes, technical compliance with disclosure rules, was totally inadequate. And here's where it gets really interesting, because it suggests the problem wasn't necessarily illegal, just incomprehensible.
Exactly. The fundamental failure wasn't always about hiding information, though that probably happened too. It was a failure to actually communicate the risk effectively. There was this massive chasm between the abstract financial engineering going on inside a mini bond CDS, CDOs, reference entities, and the understanding of the average retail investor. The documents, the prospectuses, they were just too sophisticated, even if they technically followed the rules, like using plain language.
So it wasn't about the amount of information, but how impenetrable it was. Tell me about the documents themselves, the prospectuses. What did they look like?
Well, the physical presentation itself was often a huge barrier, almost hostile to reading, you could say. Think dense blocks of text, fully justified lines making it hard to track, very little white space, maybe no helpful columns or graphics, and often really small print size, which, remember, was a major issue given that many of the target investors were elderly.
It sounds like a document designed to be legally compliant, but practically unreadable. Like, here's 200 pages of tiny, dense text. Good luck.
It creates that exact psychological effect. The investor looks at it and thinks, there's no way I can understand this. I'll just have to trust the nice person at the bank who's explaining it to me, which is incredibly dangerous.
And even if you tried to read it,
you'd immediately hit a wall of jargon, technical terms just thrown around, tranche, call option, credit default swap, reference entities, subordination. Sure, they might have been defined somewhere in the glossary, maybe. But for a normal person, that language just obscures the real danger, that dual default risk we talked about, the fact you could lose everything. It wasn't made clear and upfront.
And the marketing leaflets.
Yeah.
The glossy brochures. They were supposed to simplify things.
Right. Often, they made it worse. They cherry-picked. They'd highlight the attractive yield, maybe mention the names of the big, safe-sounding reference entities, but they'd downplay or even omit the really crucial risks. Standard warnings like investment involves risks or not principal protected might be there in the small print, but the sheer magnitude of the risk, losing 100% of your capital, that often got buried deep in the full prospectus, not featured prominently in the marketing stuff.
And didn't the sources mention other things in the marketing materials?
Yeah.
Like free gifts.
Yes, that's another classic sales tactic, offering small incentives like a free gift if you invested a certain amount. It sounds minor, but it subtly distracts the investor. It shifts the focus away from the seriousness of the financial decision risking your life savings towards getting a small, immediate reward. It's all part of creating an environment where critical assessment is less likely.
So high commissions for the sellers, gifts for the buyers, complex jargon, unreadable documents, it all points to a system failure. What was the big regulatory takeaway? How did regulators propose fixing this?
The consensus afterwards was that technical compliance just wasn't enough. You needed something much clearer, much more direct. The idea that gained traction was inspired, as the sources note, by things like warning labels on cigarette packs, a standalone risk awareness statement.
Like a big red flag on the front.
Essentially, yes. A separate, concise, easy-to-understand document, stripped of all the marketing fluff, all the jargon, just the critical risks laid bare, designed purely to make the investor stop, pause, and really think before signing on the dotted line.
And what absolutely had to be in that statement? What key questions did it need to answer?
The proposal boiled it down to 4 essentials for that threshold decision. 1, what actually is this product in simple terms? Forget the fancy name. 2, who is actually responsible for paying me back? Crucially, this needs to highlight the counterparty risk, like, is your money dependent on Lehman Brothers staying solvent? That needs to be crystal clear. 3, how risky is it really? What's the absolute worst case scenario? Can I lose everything? And 4, how easily can I sell this if I need my money back quickly? Is it liquid or am I stuck?
The focus really shifts from burying details and complexity to isolating and highlighting the potential for catastrophe.
Exactly. Especially that counterparty credit risk. Who stands behind the promise?
But this brings up a deeper, almost philosophical question, doesn't it? Which the source material touches on. If a product is so complex like these mini bonds were, can any amount of disclosure truly make it suitable for a retail investor? Is effective disclosure even possible in that scenario?
That's the million-dollar question, isn't it? The regulatory paradox. The findings really suggest that disclosure alone, even with a perfect warning label, probably isn't enough if the underlying financial literacy of the target audience isn't high enough to grasp the concepts. Maybe the real lesson is that certain types of products, these highly complex derivatives, just shouldn't be sold to retail investors at all. Regardless of how good the warning label is, the inherent complexity itself might be the barrier.
Okay, we've seen the global trigger, the U.S. roots. We've seen the devastating impact on individual investors in Asia through things like mini bonds. Now let's circle back to China. We talked about the institutional shock, the $10 billion loss, the $400 billion near miss. How did that translate into actual policy on the ground? Because the response was, well, massive.
Massive is an understatement. It was incredibly swift and forceful. The Chinese leadership basically looked at the global situation post-Lehman and decided they couldn't rely on external demand or stability anymore. They needed to act decisively, domestically. So in November 2008, barely 2 months after Lehman collapsed, they announced this very large stimulus package. The headline figure was 4 trillion yuan.
4 trillion yuan. How big is that relative to their economy?
It was huge. That 4 trillion planned for spending over 2009 and 2010 represented about 12.5% of China's entire GDP in 2008. A colossal state intervention.
Unbelievable. Where did all that money go? What was the strategy?
The strategy was very focused. The overriding goal was to maintain economic growth. They specifically targeted 8% GDP growth, primarily to ensure employment and social stability, because global demand for their exports had just cratered. So where did the money go? Overwhelmingly, the sources say over 90% of the central government share went into infrastructure.
Building things.
Exactly. Railways, highways, airports, urban development projects. Plus, there was significant spending on reconstruction after the devastating Sichuan earthquake earlier that year. Importantly, they deliberately tried to avoid funding new factories or manufacturing capacity because they already had too much of that, given the global slowdown.
So it was a pure investment-led stimulus. Use existing capacity in things like steel and cement, employ construction workers, build tangible assets, don't just hand out cash.
That was the plan. Utilize the inputs they had. But this massive spending program was only one side of the coin. It needed funding, and it was accompanied by an equally aggressive monetary policy expansion. The People's Bank of China, the central bank, slashed interest rates and basically opened the floodgates for bank lending. Liquidity flooded the system.
And this led to a credit explosion.
Astronomical is the only word for it. The amount of new bank loans issued just surged. In the first 3 quarters of 2009 alone, new bank credit hit 9.22 trillion yuan. Now, get this. The official government target for new bank lending for the entire year of 2009 was only supposed to be 5 trillion yuan.
Wait, they lent almost double the entire year's target in just 9 months?
Yes, they blew past the target massively.
How does that even happen? Does it mean the government was essentially ordering the banks, many of which are state-owned or state-influenced, to lend, regardless of normal credit checks?
That's precisely what it implies. It wasn't just market forces. Policy was dictating credit expansion on an enormous scale to meet that GDP growth target. And predictably, when you pump that much credit, that much liquidity into an economy that quickly, you start seeing serious side effects. Overheating, asset bubbles.
How quickly did those bubbles start to reappear? Weren't they worried about that, given the global context?
They probably were, but the priority was growth and stability now. The bubbles came back almost immediately. The stock market, which had tanked along with the rest of the world, saw this sharp rebound. The Shanghai Composite Index started climbing rapidly again, heading back towards 3,400 from its low around 1,800. And crucially, housing prices in the major cities, which had maybe softened a bit, started rocketing upwards again. The very asset bubbles the GFC might have popped were being reinflated vigorously by domestic policy.
So the cure for the external shock was creating internal overheating. Our sources mention a specific economic indicator here, the M1 GDP gap. Why was that flashing red warning signs?
Ah yes, the M1 GDP gap. It's a bit technical but crucial. M1 is basically the measure of the most liquid money in the system. Cash, checking accounts, money ready to be spent immediately. Now, if M1 is growing much faster than nominal GDP, which is the value of all goods and services produced, it means you have this huge overhang of cash sloshing around the system that isn't being absorbed by real economic activity.
Too much money chasing too few goods or assets.
Exactly. And in 2009, that gap between M1 growth and nominal GDP growth in China hit a historical record. It was off the charts. What that signals, according to the analysis, is very large inflation pressures building up under the surface. It's a classic sign of potential future inflation or asset bubbles because all that excess liquidity has to go somewhere.
Okay, so China successfully navigated the immediate aftermath of the global crisis. They engineered this rapid recovery, avoided a collapse. But it sounds like they did it by taking on enormous future risks, trading short-term stability for long-term structural problems.
That's a very good way to summarize the trade-off. The stimulus worked in the short run, GDP growth stayed high. But the long-term costs are significant and still being dealt with today. First, you have the legacy of all that infrastructure spending. Many projects were rushed, maybe not economically viable, so you risk having lots of non-performing assets, roads to nowhere, empty airports that don't generate returns, and become a drag on the economy.
And that puts pressure on bank balance sheets and government budgets down the line.
Precisely. Who pays for the losses on those bad investments? It creates a long-term fiscal burden. Second, and maybe more fundamentally, it potentially compromised the quality and sustainability of China's growth model. When lending decisions are driven by government directives to hit growth targets, rather than careful market assessment of risk and return, you inevitably get misallocation of capital. You sacrifice efficiency for speed. They effectively managed the immediate global crisis by planting the seeds for future domestic financial risks, particularly in the property sector and local government debt, which are huge issues now.
So when we pull all these threads together, from the U.S. to Hong Kong and Singapore, back to China, there's a clear pattern. Low interest rates globally start this frantic search for yield. That search incentivizes the creation of incredibly complex, risky financial products,
The Minibonds.
which are then misrepresented or poorly explained to vulnerable retail investors,
Right.
leading to devastating losses when the underlying risks materialize.
And then, on the institutional side, the shock forces governments like China's into massive, arguably risky domestic policy responses to insulate themselves, creating new problems down the road. That synthesis is spot on. The yield chase is the engine. The mini-bond crisis perfectly illustrates that deadly mix: complex finance, low financial literacy, and sales tactics driven by commissions. And China's stimulus shows the difficult choices countries face when the global system itself seems unstable. They opted for massive internal action, treating future efficiency for present stability, leading to those domestic bubbles in property and stocks.
But if we zoom out even further, look at the really big picture. The source material we reviewed makes a deeper argument. It suggests the fundamental flaw isn't just bad products or inadequate regulation in one country or another, it's the very structure of the international monetary system itself, the role of the US dollar.
Yes, that's the ultimate structural critique offered, and it was voiced quite strongly by figures like the governor of the People's Bank of China around that time. The argument goes like this. Because the US dollar is the world's main reserve currency, the US basically faces, as the critique puts it, no disciplines.
What does no disciplines mean in this context?
It means the U.S. can run persistent current account deficits, importing more than it exports, and large budget deficits, and the rest of the world effectively has to finance them. How? By buying U.S. government debt, U.S. Treasury securities, countries like China accumulate massive amounts of dollars through trade, and to keep their own currency stable and have reserves for crises, they recycle those dollars back into low-yielding U.S. Treasuries.
So China ends up holding trillions of dollars in U.S. debt, partly as self-protection, a hedge against global instability.
Exactly. But it's an incredibly expensive and potentially risky hedge. Think about the economics of it. China uses its own resources, its labor, its capital, often financed at higher domestic interest rates, to produce goods, gets paid in dollars, and then lends those dollars back to the U.S. government at very low interest rates. It's like borrowing expensive money to lend out cheap money.
And all those dollar holdings are vulnerable.
Constantly. Vulnerable to two main things. First, depreciation risk. If the U.S. engages in very loose monetary policy, prints a lot of money, the value of the dollar can fall, eroding the real value of China's massive reserves. Second, they're vulnerable to exactly what they feared in 2008. Another crisis originating in the U.S. financial system, or even a full-blown dollar crisis, which could make those assets illiquid or worth much less.
So they're trapped, in a way. Holding dollars is risky, but not holding dollars or trying to sell them quickly could destabilize the whole system and hurt them even more.
That's the dilemma. And this inescapable situation, this frustration with the risks inherent in the dollar-centric system, led directly to those calls for reform coming out of China.
They didn't just complain. They proposed an alternative.
Yes. The PBOC governor, Zhou Xiaochuan, quite famously proposed moving towards a different system. The idea was to replace the U.S. dollar's dominant role with a new and widely accepted reserve currency with a stable valuation, something less dependent on the policies and risks of a single country.
And the specific mechanism suggests it involved the IMF's special drawing rights, the SDR.
That was the main proposal. Enhance the role of the SDR. The SDR isn't a currency itself, but a potential claim on a basket of major currencies: dollar, euro, yen, pound, and later the renminbi. The idea was if the IMF issued more SDRs and countries could hold and trade assets denominated in SDRs, it would create a more diversified, more stable international reserve asset. It would allow countries like China to reduce their over-reliance on the US dollar, gain stability, and maybe, just maybe, impose some external discipline back onto US policy.
So we've traced this whole story, from a few basis points of yield being chased in the U.S., through the complexity of derivatives sold in Asia, the resulting retail devastation, the massive state response in China, all the way to a fundamental challenge to the global monetary order and the dominance of the U.S. dollar. It really shows how interconnected everything is, and how actions in one part of the system can have profound, unexpected consequences everywhere else. The simple act of lowering interest rates set off this incredible global chain reaction.
It absolutely did. The core lesson seems to be, when money becomes too cheap globally, complexity inevitably rushes in to offer yield, disclosure systems often fail under the strain, and the resulting crises rarely stay local. Pain gets spread far and wide.
Which leaves us, and you the listener, with a final thought to chew on. We've seen the cycle. Low rates, yield chasing, complex products, crises, bailouts, maybe some regulatory tweaks, but the underlying structures often remain. So given that the fundamental issues with the dollar reserve system haven't really been resolved, and countries like China continue to hold vast sums of U.S. debt, facing that same costly dilemma, what does that imply about their willingness to keep financing U.S. deficits indefinitely? And looking ahead, how might they really try to diversify away from the dollar next time a major shock hits? Will it just be calls for SDR reform again, or could we see more radical moves?